Hello friends, now I would like to welcome you to the lecture series 2 of Unit 6 Mutual Funds. In lecture 1 we have already seen the concept of mutual funds and the functions of mutual funds and advantages and disadvantages of mutual fund. Now you have already come to know what the mutual fund is. Mutual fund is a kind of investment proposal where the funds are collected from all the investors and the mutual fund agencies will invest that collected fund in a specific investment proposals in the stock exchange. So the investors, individual investors whose money is not sufficient to invest in a large sum in the stock exchange markets, mutual funds will help such people. The small units are collected from each investments by the mutual fund agencies, and the mutual fund agency issues the mutual fund bonds to them, mutual fund instruments to them. So it may be any amount. There is no specific minimum requirement and all that. Minimum of even 1000 rupees also you can invest in mutual funds. So such small units which are collected from individuals is made a collective fund, and this fund is invested in the stock exchange market, and whatever the return comes out of it will be shared to the investors based on the investment values, whatever the investment proportions they have made. To that extent the income is distributed to them, excluding the management charges and all that. The mutual fund agencies charge the management expenditures and profits for the activities or services what they render. So this is what we call as mutual fund we have seen. Now in this lecture series we will discuss the types of mutual funds. What are the various types of mutual funds? If you see this picture, you will find out easily what are the various types of mutual funds. Mutual funds can be classified into four different categories based on certain aspects. For example, based on the fund scheme, we can classify the mutual funds into close-ended funds and open-ended funds. And based on asset invested in various instruments, we can classify the mutual funds into equity-based mutual funds, debt related mutual funds, and hybrid mutual funds. And based on the investment objective also, we can classify what is the purpose of investment by the investors, whether they want a growth in the capital invested in their mutual fund investment value, that is called growth funds. If they want returns on the mutual funds, income funds, it is called as income fund. If both are required to certain percentages, then we can call it as a balanced funds. We have another category called specialty funds, where we classify them into index funds, sector funds, regional funds, and tax saving funds. Remember, friends, in the examination, question will be asked to discuss the various types of mutual funds. You are supposed to discuss with this category with the sub types and all that. Sometimes the question may also be asked in the examination, like what is close-ended mutual funds? Distinguish between the close-ended mutual funds and open-ended mutual funds. Sometimes the question may be asked in the examination in the short notes, the close-ended versus open-ended mutual funds. So like that, question may be asked in any way. Please prepare. It is very easy and interesting. So let us see each one of them in detail. Based on the fund scheme, mutual funds are normally classified into open-ended and close-ended. What is an open-ended mutual fund? Open-ended mutual can be bought and sold at any time. See, whenever the investors want to invest money, whichever, if they get any additional income and they want to invest money in mutual funds, they can buy mutual funds which are readily available in the market through any mutual fund agencies. Like if you go ask the HDFC or SBI to offer you a mutual fund, immediately they will provide you. So there is no any date or time restrictions in the investments and in the withdrawal also. So such funds can be bought and sold at any time. There is no time restriction. Suppose, for example, if you want to invest in blue chip growth funds of SBI, you can invest money at any time and withdraw money at any time. Suppose if you have 1 lakh rupees in cash in hand, and if you want to invest money there, you can invest money. After 6 months, if you need a cash, that investment needs to be liquidated. So these blue chip bonds can be sold at any time and you can withdraw it. So here the fund manager is going to create a corpus funds for buying and selling these kind of securities. Whenever there is a need arises with the investors, the liquidity should be provided by the investing what you call as a fund managers like SBI for mutual funds or HDFC mutual funds or ICICI mutual funds like that. They should always provide the fund available to the investors. So liquidity possibility should be there. That's what open-ended mutual funds. There are certain funds called closed-ended mutual funds where these funds will be issued in the stock exchange markets or through secondary markets, or what is called as initial fund offer. Initial INTIO initial INITI initial fund offer. It opens on one specific day and closes on one specific day. When it closed, it cannot be invested or offered from investors. Say, for example, when the initial offer opens for such mutual funds, say, for example, specifically Reliance, a future group in mutual fund investments or specific sector mutual fund opens in the market and it is traded through stock exchange by stock exchange authorities. It is open to the public for a specific period of time. So at that time, the people have to invest. Say, for example, the opening of investment option will be open for 15 days. So all the offers made or purchases made within the 15 days will be accepted, and only those who place an order during that particular time are issued the mutual fund of the bonds. But after the closure, it cannot be invested. It cannot be invested and it cannot be sold also. It cannot be withdrawn also because there is a lock-in period of specific period of time. After the closure, for the next 5 years or 10 years, the withdrawal is restricted to the investors. In such case, there is no liquidity with the investors. And if at all during the lock-in period, if the investors wanted to withdraw money, they cannot withdraw it directly from the fund managers. They have to sell that security in the stock exchange market only based on the market price, and they have to liquidate it. It means that the same fund will be transferred to some other fund, but it will not get exhausted or will not be closed. The investment cannot be closed. So that is what we call as closed-ended policy in mutual funds. Now let us see the difference between closed-ended and open-ended mutual funds, how they are different. For example, the first one is NAV, net asset value. In case of open-ended funds, net asset value changes every day because whenever the investors are investing more, the demand is more. So there will be a price may be falling down. Sometimes if the demand is more, if the more investors are investing money in that particular fund, prices will raise. And if more of the people are withdrawing money, then the prices will fall down. So there is a fluctuation in the net asset value of the mutual fund units in the market. Whereas in closed-ended, listed at the time of that is initial offer, right? New folio offer. At NFO time only, the prices will be shown. Say, for example, 1 unit of the mutual fund may cost you 10 rupees and you have to buy 1,000 units, means you have to pay a minimum of 10,000 rupees in this fund. So this price is fixed, unit value is fixed, and it remains throughout the existence of that mutual fund. But in open-ended, the fund value will be changing. Listing on the stock exchange is concerned, these kind of open-ended policies are not listed on the stock exchanges. It is directly managed by the mutual fund agencies like ICICI, HDFC, mutual funds like that. But whereas closed-ended are always on the available on the stock exchanges. So these are floated by the specialized mutual fund organizations, and they come out with the specific mutual fund offers that is at a closed-ended in the stock exchange market. And entry and exit, in case of open-ended policy, one can invest and redeem at any time. He can enter and he can exit at any time. There is no restriction. There is no restriction. Whereas in case of closed-ended policy, one can invest only at the time of a new fund offers and exit after the fund matures. He can exist only after the fund is matured. But in case in between, if liquidity is required, he can transfer it to some other person, where the transfer cost and exit load he has to bear. Then liquidity is concerned, in case of open-ended policy, investment can be redeemed at any time. So liquidity is high liquidity is available. Whereas in case of closed-ended policy, partial liquidity due to listings on stock exchanges. So you cannot withdraw it within the time, but you can discount that particular investments by investing, selling it to somebody else, either at a discounted price or at a premium price based on the market value of that particular share, but that particular mutual fund. But it is not so easy, not so flexible to liquidate the closed-ended mutual funds. So normally closed-ended mutual funds are invested by the people who don't require money for that particular specific period of time. But open-ended funds are invested by those people who want the liquidity at any point of time. Asset base is concerned, in case of mutual funds, the face value of the mutual fund keep changing. Whereas in case of closed-ended funds, the face value remains the same, that is stable till the maturity. Freedom of fund manager, if you consider fund manager is under pressure in case of open-ended policy, fund manager is under pressure of operating under fluctuating asset base. So he has to keep the reserve stock of capital. Whenever the demand arises from the investors to withdraw money, he should be able to redeem it. So that is how the fund managers, means the mutual fund agencies, are under pressure. But in case of closed-ended policy, mutual funds managers do not have to worry about the withdrawal, as asset base is stable. Hence, fund managers can facilitate for the transfer of share that mutual fund from one person to another person. So the liquidity will be happening based on the sale, but not on the redemption. There is no possibility of buying back the investments and buying back the mutual funds and paying money to the investors. But in case of open-ended, that is possible. So they are under pressure of maintaining the liquidity. A systematic investment plan, what is called SIP, systematic investment plans, in the sense every quarterly or monthly, if the investor investing for a specific period of time for a specific period of amount for a specific period of time. Say for example, an investor wanted to invest 5,000 rupees till the retirement of his what you call as service. He can take such kind of mutual funds and go on investing every month or every quarterly like that. It is possible only in case of open-ended policies. So in this case, the fund managers receive the regular investments from the investing investors, and after the specific period of time, the maturity will be made and the funds are returned back, the grown funds are returned back to the investors. That is what we call a systematic investment plan. Due to systematic investment plans, today we have mutual funds which are targeted with the pension what you call as related plans, or child education related plans. They are all open-ended funds. Whereas in case of closed-ended funds, investors can only invest at the time of new fund offers in lump sum, in a lump sum amount. There is no systematic investment plan possibility. You have to pay one single shot. Say for example, 1 lakh, if you want to invest, you can invest only 1 lakh rupees at a time. But in systematic investment plan, every year you can invest 10,000 rupees for 10 years and make it 1 lakh rupees, something like that. So in this closed-ended funds, only the people who are having a huge money in their hands can offer this kind of closed-ended policy. Whereas open-ended policy is more suitable to the people who earn the income every month and want to save money regularly. For such people, open-ended funds are very good. Risk is concerned, in case of open-ended policy, less risk when compared to closed-ended funds. Why less risk? Basically because the liquidity is possible with the investors. If the investor finds that the market is falling down and the prices of the mutual funds units are coming down, he can stop that falling of that particular thing by withdrawing or by withdrawing the funds. So his risk will be safeguarded. But in case of closed-ended policy, when the scrip prices are falling down and the face value of that particular mutual fund is falling down, the investors cannot withdraw it because there is a lock-in period. There is a lock-in period in the withdrawals. So there is a high risk of suffering the loss. Track record, if you consider investors can track the historic returns of these funds because these funds will be prevailing for a long period of time. Say for example, pro growth investment of HDFC, Sanchay Pro Growth Investment Plan of mutual fund. So it is a systematic investment plan. If at all anybody wants to invest in this and they wanted to check whether the fund is growing or not, there is a historical statistics available with the company. He can easily check out how the unit value of that particular mutual fund is increasing or decreasing, fluctuating and all that. But this is not possible in case of closed-ended funds, because in closed-ended funds, it is a fresh issue, the new investment proposal. So that particular script does not exist in previous past and will not be there afterwards. So the investors cannot check that. Investors can trust based on the fund managers the fund manager's abilities or the mutual fund agency's performances and invest money. So that's why it is a little bit risky also. So these are the basic differences between closed-ended and open-ended mutual funds. On the other category number 2, we have one more classification called based on assets in which the fund is invested. So mutual funds can be classified into 3 categories like equity fund, debt fund, and hybrid fund. As it is very clear to understand, in case of equity fund, the whole investments made by the mutual fund investors is invested in equity shares, equity market. So it is more fluctuating and more risky. Those who want to gain more capital appreciations in future, and those who want to wait for a long period of time, long-term investments, they prefer this equity fund. Whereas the debt funds are concerned, the whole fund is invested in debt bonds where the return is assured, but the growth is not assured. Say, suppose if you invest 1 lakh rupees, 1 lakh rupees remains the 1 lakh rupees only for several years. It may not change because debt bonds are like that, where the returns are concerned, returns are assured. Say, for example, 10% return, if it is assured, 10% you will get it every year. So that is how, in case of debt bonds, the people who don't want to take more risk will invest money in the debt bonds, where the capital, the value of the fund is constant, whereas the return is assured. In case of hybrid funds, it is given to those investors who are partially ready to take the risk and expect the returns also. So it is a combination of both investments in equity fund and debt fund, both. For example, if the investor is investing 50,000 rupees in a mutual fund, he can insist the mutual fund agency that 25% is in equity fund and 75% in debt fund. So the investment is made like that only. So he has 75% guaranteed return, whereas 25% is growth return assured. So these hybrid funds will give a good rewards in several times to the investors. So these are the different types of mutual fund based on the fund invested. On the other contra, the next third level of this classification based on investment objective, for which purpose the investor is investing money. Some investors are interested in growth of funds, but they are not interested in the returns. They don't want a regular return on the investments, but they want the growth of the fund. For example, most of the time the pension fund investors do not expect the return every month during the service time, but they expect the return after the what you call as retirement. So till the retirement, they don't expect any kind of return. So in such cases, they prefer to invest money in the growth funds, where the growing stocks are given a high capital appreciation, where the investment is made by the what you call as the asset managers, or what you call as mutual fund agencies. Investment will be made in the growth funds. Whereas in income funds are concerned, after the retirement, the people who get the lump sum funds from their employer, they want to invest in the income funds because their regular salary is stopped. Now they are depending on that particular returns. So they are more worried about the fixed rate of returns. In such case, the objective of the investment is to get the income regularly. The balanced funds again is having a both, that partial is in a growth fund and partial is in the income fund. Like that, classifications are made. Now the last one is specialty mutual funds. Specialty mutual funds are the specific quality of mutual funds, where they are classified into four different mutual funds: index mutual funds, sector funds, and regional funds, and tax saving funds. What is this index fund? Index funds which are traded in the stock exchanges based on Sensex index. See, the investors who are investing money, there are two types of investors. One is called as active investors, and the other one is called passive investors. The active investors are those who depend more on the financial experts. Based on the advices of the financial experts, they invest money in the stock exchange because they don't have much information about the stock market, but they actively get involved in the decisions of the experts and invest money. So in such cases, the mutual fund agencies will give them a continuous information of particular funds, growing funds available. Based on the instructions of that, they go on investing the money. Whereas there are some people called as passive investors. Passive investors are more depending on the stock exchange market operations. They go through the index level, and those index prices which is high, they try to invest money in those kind of things, expecting the returns. Say for example, in case of index funds which are traded in the stock exchange based on Sensex index. Sensex means sensitivity, exchange market sensitivity information. For example, it is counted in terms of points, like BSE has called BSE 30 Sensex index, whereas National Stock Exchange is called as Nifty, that is index of 50 scripts. So based on this, it talks about the market characteristics, how the scripts are increasing. There are some scripts which are whose index prices are high, some scripts whose index prices are low, below. So average index price, whether it is growing in that particular scenario or not, is being shown. Based on these details, some investors are investing money in those kinds of things. So index funds are those which are under this declaration of a sensitive index numbers, and based on that, they are traded on the stock exchanges where the investments are made by the investors. So that is called index fund in mutual funds. There are many funds which are traded through stock exchange operations, and those script prices are, those mutual fund prices are also mentioned in the Sensex index. So investors are investing in such kind of things called as index funds. There is something called as sector funds. Mutual funds invested in special sectors like pharmaceutical sector, service sector, manufacturing sector, funds sector. So the investors in this case do not depend on the sensitivity index, but they depend on the performance of a particular sector in future. Say for example, in case of COVID, pharmacy sector was gaining more. So where other sectors are not doing well. So investors, wise investors invested more money in the pharmaceutical sector, because during COVID time, manufacturing sectors were totally under loss because the goods were not demanded by the people, since the people tried to postpone their consumptions due to COVID problem. Whereas in pharmaceutical products as concerned, all the people were running behind the medicines. So medicinal companies started earning a huge amount of profit. So anticipating this, some of the investors invested money, mutual funds, in the pharmaceutical sectors, and they got more increase in the growth in the asset value of the mutual funds. So this is what we call as sectoral investments. Sometimes the service sector may be gaining more momentum. So based on the economic conditions, these investors analyze and invest in the sectoral funds. So these mutual funds are targeting a specific sectors. They are called as sectoral fund. There is something called as regional funds, investment pertaining to jurisdiction of the country like India, America, Europe, based on the country. So mutual funds are invested in certain countries. For example, based on the environmental analysis and political changes and all that, investors may invest money in the foreign countries also, and in India also. They can, if most of the mutual funds available in the open-ended market are all Indian based, jurisdiction is India. But if you go for other kinds of investments, you have chance to invest money in the other country also. The mutual funds which are which the mutual fund agencies are investing money in the foreign companies, like foreign direct outflow in that way. So they can be also be chosen. That is a possibility. That's called regional funds. There is a last type of a fund called tax saving funds. Some people are interested in saving the tax. In tax, say for example, if their income is more than the income slab, if they want to save money in the tax funds, they can invest money in the tax funds. There are certain kinds of mutual funds which are whose income is tax free, and investment made in those mutual funds are subject to under section 80G rebate also. So such specific funds are available. So the only point is, once the tax saving funds are offered, mutual funds, the mutual fund cannot be withdrawn for a period of 5 years. You cannot withdraw that particular funds, because in tax saving scheme, you should maintain that investment just at least for 5 years. And if any return comes out of that investments, no return is taxed. But in other cases, in case of mutual funds, when you get the returns, the appreciation value of the capital gain is taxed also. So that is how capital gain tax is subject in other cases, but not in the tax saving funds. Only thing is, in tax saving funds, there is no liquidity till 5 years. It's what the. So these are the various types of mutual funds. I thank you for your patience listening, and we will see the remaining aspects in the next class. Thank you. Thank you, one and all.